whether you're trading CFDs or you're trading Forex or you're trading stocks on the exchanges, okay, the same technical analysis holds true. The way you trade is different, but your analysis would be the same. And tonight we're going to be talking about retracements and reversals. And for some reason, the word reversal freaks people out. And anytime price moves against them, they think the whole market's reversing. The thing is, you have to understand what the difference is between a retracement and a reversal. Now, if you accept the fact, and it's not my fact, it is just the law of the market, say, that an asset can either move sideways, it can move up, or it can move down. That's all the possibilities, right? There's not another possibility in that now. Most of the time, the markets spend their time moving in a congested kind of mess sideways. They might be moving up a little bit in price, but they're moving in a congested mess. Okay. We can't trade in that congested mess, or we shouldn't be trading in that congested mess. Oh, hold on a second. There we go. Now, there's also times where the markets will move up, and they're hard to decipher it, but they're moving up. There's also times when the markets are moving down, but they're not qualified, say, trends. Okay. What we as traders want to look for are uptrends and downtrends. And the more well-developed the uptrend or the downtrend is, the better we can trade. So if you understand that the markets spend most of their time in random activity, there's millions of human beings all over the world affecting the markets, no matter how they're trading. No matter whether they're trading from bots, no matter whether they're trading from black boxes, no matter whether they're professional traders or retail traders, they're all over the place and they're making decisions. And these decisions affect the markets. So you've got to believe that the markets are completely random. Price moves in random behavior, except during very specific times. And when price moves in a trend, whether it's an uptrend or a downtrend, it starts moving or exhibiting non-random behavior. This non-random behavior, this time of non-random behavior, which we know as trends, is the times that we can properly evaluate the markets, apply rules to the markets, and make smart trading decisions. Okay. Now, if you think of a trend, okay, think of it as a locomotive. Okay. Yeah. This locomotive starts off at the the gate, and it starts building steam and chugging along. Okay. Now, once it starts chugging, once it starts moving, remember the old Western movies where you'd hear the engine, the whistle go, and you see all the steam coming out of the sides, and you hear the chug, and the wheels will start turning, and that train would slowly start moving out of that station. Guess what? That's exactly what a trend does. Because you have price going here, price going there, and at some point, for some reason, it starts to gather steam. Okay. When it gathers the steam and starts chugging along, it starts picking up speed. And this is what happens in a trend. It starts building energy. And I read somewhere once that a locomotive traveling at 60 miles an hour requires like 5 miles to stop. They could slam on the brakes, but the train would eventually have damage. It would maybe flip off the tracks. You can't stop it on a dime. Well, a trend has energy. A trend has momentum. So what happens is, for some reason, traders, and most of the time, none of us can tell why. Okay. don't know. We can decipher it after the fact. And you have all these gurus patting themselves on the back to tell you they knew and they predicted it, but most of them don't even realize it's happening when it happened. It's very easy a half hour later to say, oh, look, we have a trend. Okay. Well, we should all realize that. Okay. But price starts getting some energy. It starts moving upward, okay, or downward. Remember, tonight, everything is both the exact opposite for down or up. Okay, so I don't have to keep saying downtrend to uptrend. Okay, now, as this momentum starts to grow, what happens is you have a whole bunch of traders sitting on the sidelines here, and they start realizing there's a price trend, and they start looking at the price of that asset, and they start jumping on the bandwagon. They start building up that head of steam. That train is now out of the station and starting to chug along. It's moving up, 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 and what's happening is more and more traders are jumping in the market. At some point, it reaches the next stop, and what happens is some of those passengers on that train already had their tickets to that stop, and they start leaving at that stop. They get off the train. As they get off the train, they're all off. The train starts to, ring its horn, its bell, and starts building up the head of steam, starts going out of the station again. And each time that it does it, it eases down. In our reality, what's happening is the traders, whether it's an investment bank, whether it's an investment broker, whether it's a big trader for investment, whoever they are, you and me, they entered the market here. They put their exit point here. Because they're trading hundreds of thousands or millions of dollars. They know they're only looking for this much profit, and they're leaving the market. They've set up every bit of their trade beforehand. Okay. Now, as they leave, what happens is we're chugging along, and some of these guys sitting on the sidelines say, "Whoa, that price has now gotten too high. I'm not going to jump back into that market." So the market starts to lose some momentum. As it gets to that station, and a lot of those passengers exit because they were pre-ticketed that station, it starts easing back down and starts getting ready to chug along again. Well, what happens is these guys over here who said that price was getting too high, when they saw it come down to here, they said, okay, it's back at a price I think is worthwhile getting in the market. And they start re-entering that market and building that steam, pushing it to the next stop. Okay, and what is that known as? This is actually a retracement. A retracement is a healthy part of a trend. If price had just moved like this, okay, and I saw price moving, I would say, wow, that's, but there's no health to that. There's something that's pushing it very hard, most likely some news, some headline, but there's no place I know that I can get in. There's no place I know to get out that's safe for me. Okay. I want to see these retracements. Okay. So retracements are momentary reversals that often occur during longer trends. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset's price action. So as you can see, there are a couple retracements that take place and occur throughout a prolonged period of time. Okay. Now, you could say, you know what, Barry's making all this up and makes these drawings and puts them on the screen. And it's easy to say that in a drawing, but it's not easy to say that in reality. But the fact is, it is. Okay. Well-developed trends happen all the time in the markets. Okay. Let's pop over to some charts. Okay. We're going over to my Euro US dollar chart. This is what I call my teaching chart. Okay. I teach all the classes using a Euro US dollar chart. Okay. I got this ready before class because I want to see if I could show you. Now, what do you see on this chart? We're in the middle of a downtrend. And what did you see? Push, ease, push, ease, push, ease, push. Okay. This is a beautifully well-developed downtrend that we could have entered at a determined point and exited at a determined point. Okay. Now, we don't know right now if this retracement right here is going to continue back into continuing run down, or will it become a full reversal? Okay. But this is how a trend runs. Now, if we were sitting on the sidelines over here and looking at this movement, we might say, well, we have this retracement price bound. I might then enter the market. Okay, this happened here. I'd say, fine, this is a good, healthy retracement. Went down, continued. I would have rode this market all the way down to probably somewhere around here. I don't think I would have stayed to here. Okay. But you could have not rode the market. You could have gotten in at a healthy point based on this prior support resistance level and exited very easily at this resistance level. Okay. Because what happens is during these trend periods, we get absolutely beautiful charts, price action talking to us. Because what happens is we start exhibiting, or the price starts exhibiting, non-random behavior. And this is a live chart. This is a chart that's up to the minute right now. Okay. And we're looking at a 1 hour chart. Like I said, I didn't go find this for you. This is my standard teaching chart in every class you attend. You'll see I teach from this chart. It's even called Barry's standard teaching chart. Okay. And here it is, happens all the time. Okay, now I just explained this as best as I could. Whether we have an uptrend or a downtrend, it is identical, it's just mirrored. A retracement is a retracement and a reversal is a reversal. Okay, so imagine you are looking in a mirror and flipping it over, it's all the same. Several people are asking me, is a downtrend a retracement? No, a downtrend is a downtrend. In a downtrend, you get retracements and you get reversals. In an uptrend, you get retracements and reversals. They're mirror images of each other. So let's go back to my PowerPoint. So the question is, what are reversals? Reversals are temporary changes in assets trend that occur over a short period of time. Oftentimes, the reversals can last minutes, hours, or days. A reversal more or less signifies that that current trend movement has expired. It's reversing. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during an asset's price action. Remember, when we're looking at price action, we're looking at the last 15 minutes, last half hour, last hour. We're trading in a very small bubble. So if we were to say hypothetically look at X, Y, and Z stock, and X, Y, and Z stock has been trading in a steady movement for the last 6 months, moving from $100 to 102, 105, in a steady little uptrend. Okay. We could take a slice of that pie for 6 hours last Tuesday and then expand that to a much bigger chart and see that on Tuesday, it went in a downtrend. Okay. And as it was trading this little downtrend, now in that longer trend, that was a retracement. In the shorter trend, it was a reversal because price reversed itself. Because in our trading window, our time frame that we're looking at is the only thing that's important to us, because we wanted to enter at a low price and sell, buy at a high price, or enter at a high price and sell at a low price. Whatever decision we're making at the moment. Okay. So in the terms of that longer trend of time, it might have been a blimp on a sky, a blimp on a chart. But in that short term, okay, so in a longer term environmental sense, you could have an uptrend with a short-term downtrend in it. Okay. Now, a couple of people ask, is there any way that you can figure out when the next one will be. No, there is no, if we could predict whether something's going to be a retracement or a reversal and where it would change, well, we'd all be rich. The fact is, there are telltale signs that might help us. Let's pop back up to the Euro US dollar chart. But these telltale signs are very, very important. What we want to do is, you can't just look at a reversal or a retracement or a reversal or a trend and understand anything. Okay. You need to have other pieces of information. So you're never, no matter how experienced you are, how good of a trader you are, you're never going to pick the top of a trend or the bottom of a trend. We call that in the industry trying to catch a falling knife. It's never going to happen. Okay. And if you're a trader who wants to enter here and exit here, guess what? You'll eventually lose your whole entire portfolio and lose all your money and be broke. Okay. A smart trader decides when they're going to enter a price and when they're going to exit a price. Okay. Now, the thing is, a retracement is very, very healthy. Okay. And you can start to predict how deep these retracements are using Fibonacci's, I use support and resistance lines. There's many different techniques. None of them are fail-proof. My support and resistance lines are on every single chart I ever deal with. Okay. And those are crucial lines because they tell you they're crucial prices. And look what happened here. Look what happened here. Look what happened here. Each time they approach one of these lines. But there's no guarantee at all that price is going to hit this level and bounce back up there. Price could continue down to here and then bounce back up. That's why with Fibonacci's, we look at 38.2, 60, 50, 61.8. No guarantee. The thing that makes you successful is being able to look at a chart, see this retracement, and be able to confidently say to yourself, this is a retracement, it's a good thing. But at what level am I going to say, it's not a good retracement? Where am I going to get out of this market? Okay. It is because there is, so as price is moving in either direction and it hits these levels, they are alerts. They're hitting you on the back end. They're hitting me on the head saying, Barry, look at your chart, look at me, pay attention. And then you want to see what it's going to do, because if you had entered this trade here to ride up to here, and this turned out to come back down to here, well, that's fine. You want to have your stop loss covering your butt. Okay. And so what? You didn't make the profit to there. You ended up getting out of here. You got in here and you made the profit, because you're never going to just, So that's why risk management and risk and exit strategies are so important. I always use trailing stops, and I'm constantly changing my stop losses. As price moves up or moves in my favor, I move my stop loss, because once I'm beyond the break-even point, I could care less exactly how much money I make. I know at that point I'm in profit, and I'll keep moving my stop loss up and up and up, because what do I use to set my stop losses? I'll use Fibonacci retracement levels. I'll use my support and resistance levels. Okay. But one of the biggest clues to successful trading isn't blindly setting a trade and going back to work at your desk. When you have an open trade, you should be monitoring that trade at all times. We're not investing here. We're not buying Google to sell 2 years from now because we're hoping, we make a lot of money on it and it goes up over 2 years. We're not investing in our retirement. So, I don't look at my retirement portfolio. I don't look at my 401k probably every 6 months. I have a self-balancing portfolio, and I just leave it alone. But you can't do that with trades. Trading requires your attention, because you need to be able to make these decisions based on what you're seeing in the price action of charts, and based on what price is doing. Because there is no way to predict what price is going to do. You can use all the technical analysis tools. You could use everything out there but nobody can predict what's going to happen. Nobody can predict what the headlines are going to do to affect anything. Nobody could have predicted the earthquake in Turkey today. Okay. And all of this affects price. Okay. And it takes, you go to work every day. You get in your car, whether you're in London driving on the M whatever, you're in LA driving on the 405, you're in New York and taking the subways out of the city. We all know by our own nature and by our experience and our time what routes are the best way to get home at what day. Now, I lived in LA and ran a company for 35 years out there, and I worked 45 minutes on the 405 from my front door to my office. But if I left after 7 a.m., that 45 minutes was an hour and a half. If I came home at 4 o'clock in the afternoon, I'd be home in 45 minutes. If I came home at 6 o'clock, I'd be home in 2 hours. Okay. But I also knew that by instinct, by experience. I also knew if I'm coming down the 405 and coming over to Sepulveda and I start to see a backup in the left lane, I'm going to jump to the right lane and get off at Mulholland and go around because I know there's this congestion, which may not be an accident. It's just congestion. And I can go the back way. Now, I know what I can do, but I have to observe what's happening. And eventually we get to know this, after all these years of driving, and my feet, my brain, I'm on the cell phone, don't tell anybody that, and doing this and doing that and listening to this and paying, but my feet and my arm, my hands on this are doing the right thing. It's all in our nature. But if you don't observe, you can't make the right decisions. And trading is about observing and making the best decision with the information possible. Because like when price reverses, most traders and investors are stuck with a tough decision. And you only have 3 options. Just like on the highway coming home, I could get in the middle lane and say I could get past through it faster. I get in the right lane and jump off at the exit, or I could just stay where I am. Guess what? Same choices trading in the market. You could hold throughout the sell-off, which could result in large losses if the retracement turns into be a larger trend reversal. You could sell and rebuy if the price recovers, which would definitely result in money wasted. And this is it. I always tell everybody, look, if price is going up steadily, you've got profit in the bank. And then you're not sure what's happening because it's easing back down. You know what? Sell, take your profit. You can re-enter the markets. Now, I would do a whole new fresh analysis, but you could jump out, book your profits, and then if what you thought was becoming a reversal becomes a retracement, you could re-enter the market. Okay. Or you could just take your profit, be happy, and stop worrying about missed opportunities. Okay. So it's no different than the 3 choices: getting off the highway, getting on the highway, staying in the lane you're in. And I said, traders have an expression for attempting to pick the bottom of the markets or top. And we call it catching a falling knife. And as the expression implies, it can be downright dangerous and is not normally recommended. Okay. Period, Dan. And I'm not going to give you a method, but what you want to do is reduce your risk. If simply moving, if you're not sure, why not move your stop loss up closer? And what's the worst? If you get stopped out in profit, you get stopped out with profit. If you don't get stopped out and it becomes a retracement, guess what? You're still in the market. Okay. So understanding risk management, trailing stop losses, moving your stop loss, having an exit strategy are more important than anything. Somebody once explained to me that when you're doing your analysis and sitting on the sidelines, you're not in the game. You're just somebody sitting out there in the crowd shouting. Okay. You're not in the game to actually open a trade. Okay. But the minute you open a trade, you put yourself at risk. Because while you're sitting on sidelines, you had no risk. And the only time that you actually leave profit is when you leave the market. So exiting is more important than anything else. Exiting with profit. Entering, you're just putting yourself at risk. Sitting at the sidelines gives you no opportunity. But if you keep in mind that retracements are a healthy thing and you don't panic and you have your proper analysis on your charts and you say, okay, I feel comfortable if it goes up to a 50% retracement. 50%, you have to decide where your comfort level is and what you feel and how long you've been in that asset. Maybe you're braver if you jumped into gold at 1250, gold went to 1300, and now it's retracing, and even if you put your stop loss, you still made yourself a considerable amount of money. Or it could have been through the second wave or the third wave. Okay. The more profit you've already got under your belt, okay, the more you can actually leave in that risk of that trade. So keep in mind, reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. Not when an uptrend or downtrend moves into sideways mess. Most of the time, that's what it actually moves into, is a sideways congested mess and sits there before it decides what it's going to do. But you only have 3 choices. So if you're in a position, you could hold on to it. 2, you could close your position and re-enter. 3, you could permanently leave the market. That's your only choices. But because reversals can happen at any time, choosing the best option isn't always easy. So you need to be prepared at all times. You need to watch. And what are the best tools for that? Fibonacci retracements, support and resistance levels, trend line support and resistance, chart patterns will help you. These are all pieces of information you put on your chart. Technical indicators and finding something overbought or over don't really help you. Okay. Actually, at this point, my firm belief is technical indicators do exactly what they do. They indicate. Price is the only thing that never lies to you. And those things you can drop over top of price to understand what price is doing right at the moment, not what the market is saying overall. What is price doing at that moment? So if you're looking at your price chart, forget the indicators below and look whether you use support and resistance. Okay. But look at price. Price will tell you a story and it will let you know what's going on. But again, you can use Fibonacci retracements. And you might say, I'll stay in the market until it hits a 50% retracement. Or, oh, I'm a 30 to 35 guy, a 38 guy. Okay. Pivot points. Yeah, let me show you. I actually have a live chart with pivot points set up for you. Okay. Again, here we have Fibonacci retracements and how they are used in all of this, as well as support and resistance lines. Okay. But it's your technique that you decide that you're comfortable with, what you want to use, what you're using already. You could use trend lines. Remember, trends move in this set movement. Now, I don't follow along with the guidelines for drawing a trend line. I believe in trends. Trends and trend lines are 2 different things. A trend is a series of higher highs and higher lows, or lower lows and lower highs. Okay. It means push, ease, push, ease, push, ease. And as long as price is continually making the higher high and then the higher low and the higher high and the higher low, you're in good shape. You have a well-defined trend. I'm not a firm believer in things like head and shoulders. I think they take way too long in our type market to develop and we don't ever see them. Triangles more or less help us see breakouts. Okay. They tell us when we could enter the markets. They don't more or less tell us when we want to exit the markets. But remember, technical analysis is a study of historical price performance to predict future price movements. Okay. Price is the only accurate measure of an investor sentiment. It is the intersection of supply and demand. Investor sentiment is at the least and possibly the more important determinant of price than fundamental factors like earnings or revenue or news and headlines. There are three important principles that govern all technical analysis. First, price is not random. Second, price anticipates fundamental change. And third, the relationship between price and time is linear. Therefore, price moves can be viewed as patterns on charts. Okay. So when we're in an uptrend or a downtrend, we have a non-random market. Now, different strategies have varying degrees of success depending upon where the market stands and what time frame you're looking at. Technical analysis is a strong uptrending market will show the basis patterns are frequently broken. Now, I believe technical analysis will help you be able to determine the environmental factors. Okay. Technical analysis will tell you whether you should be looking to buy or whether you should be looking to sell, whether the market's overbought or oversold. It will give you some indications. But technical analysis doesn't give you an entry point and exit point. It doesn't tell you to put your stop losses, and it doesn't tell you about retracements. So all they can do is give you some general information. Price action is ultimately what's important. Okay, somebody asked me, does the selection help? Does the period selection help to better observe retracements? No. You could change your chart to a 1 hour, to a 1 day chart, and you can always find a retracement. If you're trading from a 15-minute chart, don't try to find something. If it's not there in that 15-minute chart that you're using to evaluate your trade and make that trade in, then it's not there. I can always extend to a time frame to find something in an uptrend or a downtrend. I can always adjust my time frames to find something to do something. This is not randomly selected. Okay, you're not trying to tell the market to show you your decision. Okay, if you're using a 15-minute chart to make your decisions, to set your entry point, your exit point, you've used that to make your whole thing. That's the chart that you are looking at now. That's the only thing in your world that matters right now. Okay, nothing more, nothing less. Okay, looking at longer period charts will help you make your decision as to if you would think it's a good opportunity to buy or sell. They will help you looking at short, medium, and long-term chart will help you make your decision as to maybe where I will put my stop loss, maybe where I think I should exit. But you don't enter a trade looking at a 1 hour, 2 hour, or 3 hour chart. You're looking for that short-term chart to enter a trade at a very fine point. You're also looking for everything that's happening in that, because you've already made all of your primary decisions before you enter the market. You're the guy on the sideline. Okay, that's when you have your time to do all your evaluation. Once you've entered the market, okay, the only control you have at that point is stop loss or exiting. That's it. So there's no other analysis you need to do, because you should have done every bit of your analysis before you made your decision. Now you're in the great game. Now you have to watch, you have to play that game, be part of it. Okay, and that requires you to follow those rules in that decision for that little trade and that period of time, whether it's 1 day, 1 hour. That's why most CFDs are closed within a very short period of time, because people don't have hours to sit looking at their charts, because this isn't an investment, it is trading. Okay, and therefore I would never, once I've got my trade set up, I've set it everything on my charts, I've got my final decision, I never change any of my charts at that point, because I'm not making any other evaluations. Now I'm only watching what price is doing to make sure that it's not moving against me or something weird hasn't happened. So of course, as with any strategy, there's no singular perfect strategy that will guarantee you profits. Naturally, that means you cannot rely on a strategy alone for profits, because it takes time between each potential opportunity. As a trader, you need to be able to differentiate between reversals and retracements. Without this knowledge, you may risk many things, such as exiting too soon or missing opportunities, holding on to losing positions or losing money and wasting money on commissions and spreads. By combining technical analysis with some basic identification measures, you are then more aware of the risk and can put your trading capital to better use. Then, once you've applied it to better use, is now making the best decisions possible. Because you've entered that game. Once you've entered it, the only way to exit it is to exit your trade. Okay. So it's to make it that best possible stuff during your time scenario. So thank you very much for joining us tonight. I hope you learned a little bit. I told you in the very beginning, I'm very opinionated. So have a great day, and we'll talk to you again real soon. Bye now.